The last aspect of our webinar, and probably one of the most important, is money matters, and that's why that brings us to the last topic, which is Shreya. Can you give a broad perspective from a cross-border angle? What are the tax issues which are usually faced in a technology collaboration
That's
deal?
really the $1,000,000 question,
Yeah,
right?
money matters.
So I think so that's obviously a very big mandate that you've just given me, because to be honest, when you say technology collaboration, there are so many different industries that fall within that bracket, and tax is to an extent very industry driven. So what I'm going to do is I'm going to divide my response into a few categories, some of which will be industry specific and some which won't. So let's pick up on withholding taxes, which we touched upon briefly when you dealt with the regulatory limits on royalty. And there we discussed how when you have Indian companies, particularly Indian companies that are related, that are subsidiary entities, what Indian tax law requires is that any arrangements between an offshore parent and an Indian company have to be at an arm's length. What this means is that if an Indian company is providing any services to the offshore parent, then the Indian entity has to be remunerated as per industry standards. So this is called transfer pricing, the broad regime. Now, what tends to happen is that India's perception of industry standards and what the markup should be is often very high. So you'll find margins of 15 to 20% being imposed even on pure service based companies which don't really have a lot of IP at the Indian entity level. So what happens is that cash accumulation ends up being a huge problem, right? And what a lot of companies started doing to address this issue of cash accumulation is that they would take out some degree of that cash in the form of royalties. And the fact that the regulatory regime opened up also made this a lot easier. Now, how the Indian tax department reacted to this is a couple of years ago, it increased the withholding tax rates on royalty payments. So the rate was increased to a 25% rate on a gross basis. So if you look at the actual income component, it was probably a much higher withholding rate. Of course, this was reducible by treaties. And what typically happens is that the IP heavy companies that India often deals with are either situated in Netherlands or Switzerland or Ireland, depending on the kind of industry they belong to. So pharmaceutical companies, for example, have a very strong base in Switzerland. If you have some of the technology companies, we've seen them operating out of Ireland or Netherlands. So all of these three treaties have a 10% rate on royalty payments, right? Now, what has happened as per the recent budget is that India, under its domestic law requirements itself, has introduced a 10% rate on withholding. And this is going to be positive, firstly, because in order to claim treaty benefits, you have to satisfy certain local Indian requirements. So, for example, you have to file tax returns in India. And if you don't file these returns, you don't get treaty benefits. So, the fact that domestic law itself has a 10% rate will be a positive development going forward. I think aside from the withholding taxes, there are a couple of other nuances that relate specifically to intangibles, which is intangibles and IP in general. So, for example, in the manufacturing sector, what often used to happen is that if you had embedded software, right, and you had certain royalties which were being paid for that embedded software, or if you had IP which was in the nature of shrink wrap software which was being sold, there was often this characterization issue about whether embedded software sold in a product should be treated as payment for that should be treated as royalty, or whether it should be business income. And of course, the withholding consequences on that would also vary, because if it was treated as royalty, that is a license of an IP held offshore, there would be this 10% withholding. But if it was treated as a pure sale of goods, right? So you're selling phones in India which happen to have this embedded software, then in that case, if it was business income, then the treatment would be entirely different. So this issue kept coming up in the context of the manufacturing industry, and India's take on this today is that if you have a pure license kind of arrangement, it is likely to be royalty. But if it is embedded software or if there is a sale component involved, then we need to look at it a bit more closely to see if the character should be in the nature of capital gains or business income, which have different source rules. So one example where this can happen is, for example, when you have infrastructure projects, where typically you'll have an onshore and an offshore component. So the offshore component will relate to the design of that infrastructure project. So you'll have your blueprints or whatever it is, which will be all handled offshore. And we've seen a lot of German companies take an interest in this as well. And on the onshore component, you'll see the actual execution and implementation. So the payment is also split into two tranches, right? And the question is always that if you're paying for certain, copyrighted material at the offshore level, whether that should be treated as royalty and whether that should even be taxable in India if it's entirely at the offshore level. Yeah.
So I think one interesting point, which I would want to highlight is, again, even for such relations or such transactions, document is sacrosanct, because
Correct.
eventually, the authorities would look at the agreements and your invoices. So we need to be mindful while drafting such agreements, and even the clients need to be mindful that the document actually specifies whether it's, the transfer is in the nature of a sale of a good,
Exactly.
vis-a-vis licensing of IP. Any thoughts on that?
No, absolutely, and it's great that you brought up that point, because when you look at it from a purely IP law perspective, you would refer to this as an assignment,
That's
right?
correct.
But from a tax law perspective, very often authorities don't understand whether an assignment should be looked at as a license or a transfer, right? Particularly if you have partial term assignments or fixed term assignments, then what really happens to the character? And I think you're right, documentation goes a long way in ensuring that you get the characterization that you think you're going to get. Typically, if you have, a complete sale taking place, so the person who is assigning this IP right is giving away all rights in that underlying IP, it would typically be either capital gains or business income. But if there's any kind of rights being retained by the transferor, it would typically be in the nature of a license that results in royalty. So that would broadly be it. And I think the consequence of capital gains and business income also should be discussed, because again, going back to the infrastructure kind of example, right? What typically happens is that you have a technology transfer offshore, and then you have the implementation piece taking place in India, right? Now, if you have implementation of any kind of project in India, then you have people coming over on a regular basis. If you have people coming over, would those people then be considered a projection of the non-resident enterprise in India? Do they create a tax presence for the offshore enterprise in India? Because if they do, then India then gets the right to tax the offshore profits of that enterprise. So again, huge impact on the Indian tax front, and our rates are not low today, right? It can extend to almost a 42% for a non-resident company. So all of these issues are pretty crucial to think about from that perspective as well.
So, just one comment or probably a question to you is: are the authorities in India aggressive on such cases, or it's just a one-off, where they try to lay a precedent? How do the authorities react on a regular basis?
So I think that's a great question, and we've seen a shift in the approach that they take over the last few years as well. So you are probably familiar with the Nokia case, which
Yeah.
made the headlines and which related again to a royalty withholding issue. And in cases like that, we've seen the authorities being fairly aggressive. Firstly, because the numbers involved were significant, and secondly, because they believed that there was a merit to the claim that they were making. So in those kinds of situations, for sure, they are aggressive, and there the documentation makes a huge difference, because the difference in the Indian regime and some countries outside India is that when we look at tax avoidance or when we look at tax planning, we still follow a form over substance approach.
Yeah.
So, what this means is that if you've contractually defined your rights and obligations as being of a particular kind, very rarely will the courts disregard that contract and impose their own notion of what the commercial reality is, right?
Yeah.
This is very different from countries which have a general anti avoidance rule, where the courts and the revenue authorities would have a larger, would have more leeway to recharacterize, right? So, for example, if you in your document say that I'm selling IP, then the court is unlikely to look at it and say what are the retained rights and are you really selling it, right? So to that extent, the right that the tax authorities have to challenge what taxpayers do is limited. Having said that, we do see challenges, particularly on the transfer pricing front. So, what is the industry price that is being paid? Is it adequate? Should it be more? We've seen some challenges on that front, and also on the characterization of royalty versus capital gains and business income. Lots of challenges on that front as well. So, I'd say it's a mixed bag, to be honest.
So you mentioned one very interesting term, general anti-avoidance rules, which is popularly known as GAR. So does India have GAR, or is it planning to have it in the near future? Any thought?
So we actually had a GAR introduced a couple of years back. It is now a part of the Finance Act. But what has happened with this year's budget is that the application of the GAR has been postponed by 2 years. So it will now only be applicable from 2017. And what they have also done is grandfathered all previous arrangements. So if you have an existing technology collaboration arrangement in place, GAR is not going to apply. But if there's anything that's being put in place after 2017 or that results in income after 2017, then there is a possibility that recharacterization will be more likely than it is today.
That's very interesting. So probably the takeaway on this for our participants is that even though GAR is not there right now, it's soon to come. But you need to be mindful that you structure your existing transactions in such a way that once GAR comes in, the broad structure continues to be protected if you're going to make further investments or make further changes to the existing structure.
Correct. So, for example, you mentioned that on the regulatory front, if you have extremely high royalty payments being made, then that has been challenged by the regulators. So today you could have such a structure challenged under transfer pricing norms. But once the GAR comes into play, there's also a possibility that they'll look at whether this is really a royalty payment or whether it's some other kind of a return that the foreign company is getting. I think one other point on the tax aspect that we should also touch on is indirect taxes, right? So today India has some indirect taxes which are levied at the central level and some which are levied at the state level. So we follow, in terms of our governance structure, we are a federation with a unitary bias. So we're similar to what America follows, except that the center tends to have more rights than they would in the United States, right? So when you look at how this impacts our tax structure, our center does have several taxing rights, but you also see the states having very strong taxing rights on certain matters. So the sale of goods is a state right, but the taxation on services is a center right today, right? And the center also levies taxes on, so it levies excise duties, it levies taxes on imports and exports. And what is proposed in the future is that all of these taxes will be brought under one common umbrella of the goods and service tax. So the goods and service tax, when it is introduced, will function similar to the VAT in Europe, which is more of a pan-country tax than all of these piecemeal taxes that we have today. But the real big advantage it will have for technology companies is that today there is an overlap between the VAT and the service tax when there is a license of IP. So a license of intellectual property can potentially result in service tax at the central level as well as value added tax at the state level, again depending on the kind of VAT legislation that a state has. Once the GST or the goods and service tax comes into play, all you're saying is that there is a tax on every additional value that accrues in relation to that particular product. So that's going to reduce a lot of the cascading effects that you face today in relation to intellectual property.
And even just a thought, even from a technology collaboration perspective, where the foreign client is giving technology or is setting shop in the manufacturing sector, where there is excise and VAT applicable, and in some cases service tax.
Correct.
With the GST coming, would it simplify the credit mechanisms which would be available, from a vertical perspective?
Absolutely. And today the main challenge with credit is that when India introduced the VAT legislation, we did not allow pan-country credits. So today, the way our VAT operates is that it's only transfers within a particular state that credit is available for, and not transfers across states. And that tends to result in a little bit of a cascading effect when there are, goods being transferred multiple times. What the GST is going to do is, firstly, it's going to remove these multiple layers of taxes, which will be hugely positive. And in fact, one budget estimate said that we're targeting an 8.5% growth rate for the coming year, which is huge when you look at global standards. But according to one estimate, after the GST is introduced, the removal of these cascades will actually result in a double-digit increase to projected growth rates. So hugely positive. I mean, if we actually hit those numbers, and I don't know if we will, but if we come even close, we'll be running at triple the growth rate of some of the more developed countries out there.
That's amazing. And I just one small point. Also, that would increase the cash flow, because a lot of technology collaborations are in the automobile industry, which are capital intensive.
Correct.
And these taxes, especially claiming credits, result in a lot of cash flow situations for companies.
Correct.
So I think probably that would also ease out once we have a uniform GST regime.
Absolutely. So I think we've probably covered pretty much most of our questions today. Ruchi, maybe you could, say a few words about how you think the next couple of years are going to look, and then we can break for questions.
Yes, sure. There are 2 points. One on EU-India relations going forward. I mean, the opportunities for collaboration and technology transfer as a process. Europe's contribution to India is still underexplored, and we see various opportunities or avenues where European companies can contribute to India's development agenda. On especially looking at the technological collaboration front, developing countries in India, like India, by encouraging FDI, not only end up importing efficient foreign technologies, but this also results in technology spillovers. For example, local firms end up adopting to foreign technologies of multinationals, by reverse engineering, by imitation, or by social engineering. So this helps results in developing technological capabilities and improving the efficiency of Indian firms. So it is more like a win-win situation for allowing FDI, importing foreign technologies into India, and thereby increasing technological capabilities of Indian companies. Looking at technology transfer as a process, it is a complex process because it involves several components: technology, taxation, commercial exploitation of the technology, as well as legal intervention. So all of these needs to be carefully examined, and several of these aspects needs to be considered. Of course, successful cases of technology transfers will, facilitate more trade and commerce between Europe and India. Failed transactions will definitely act as barriers for their activity. I think that's it from my end. I think our attempt was to, explain to you about the opportunities that exist for European companies in India, and also provide and basically introduce legal regulatory tax regime surrounding it. The intention was not to keep you bombarded with technical stuff, but to provide more practical perspectives and actionable takeaways. And we'd like to thank you all for participating and joining with us for this webinar. I, on behalf of Mr. Desai Associates, will also like to thank our partners, Standby Center for Technology Transfer India, Indo-Italian Chamber of Commerce and Industry, and Baden-Württemberg Connect to partner with us for this webinar. Thank you, everybody, and have a nice day.